Hey everyone, welcome back to the channel. Today we're diving into the FTSE100, one of the world's most popular stock indexes for dividend investing, to bring you 5 of the top dividend stocks to invest in right now. If you're looking for steady income and reliable returns, dividend stocks are a great way to build wealth over time. They act as a stronger hedge against inflation than bonds do, and the FTSE100 is home to some of the largest, most stable companies in the world, trading at very reasonable and in some cases very cheap valuations. So whether you're a seasoned investor or just starting out, stick around as we break down these dividend powerhouses that could boost your portfolio. Welcome to Wise Wealth, where we dive into all things personal finance. If you like this type of content, make sure to give it a like down below and consider subscribing for more personal finance and investing content. Without further ado, let's get into it. First on the list is National Grid, which is a UK-based multinational company that plays a pivotal role in the country's energy infrastructure. As of today, the stock yields 5.46%. The company is responsible for transmitting and distributing electricity and natural gas across the UK and parts of the northeastern United States as well. It operates the high-voltage electricity transmission network in England and Wales and owns and manages gas distribution networks that keep homes and businesses powered. National Grid is essentially the backbone of the UK's energy grid, ensuring reliable delivery of energy to millions of consumers. For dividend investors, National Grid is a popular choice due to its consistent and reliable income stream. As a utility company, it operates in a relatively stable and regulated sector, which means it can offer dependable cash flows even in times of economic uncertainty. Dividend-seeking investors are attracted to National Grid's ability to generate steady profits, which has allowed the company to offer generous dividend payouts. The predictability of its revenue, tied to long-term infrastructure projects and contracts, further solidifies its reputation as a strong dividend-paying stock. In terms of size, National Grid is one of the largest publicly traded companies in the UK, with a market cap exceeding £50 billion. National Grid's operations are not only critical for the UK's energy security, but also contribute significantly to the economy, employing thousands of people and investing heavily in future energy infrastructure, including renewable energy projects. National Grid has paid a dividend for over 30 consecutive years, making it a cornerstone for income-focused investors. Even more impressive is the company's track record of maintaining or growing its dividend for nearly 20 years, except a small dividend reduction in 2011. This long-standing commitment to returning value to shareholders, along with its defensive qualities, makes National Grid a reliable option for investors seeking both income and stability. Number 2 is Aviva, which is one of the UK's largest insurance companies, providing a range of services including life, general and health insurance, as well as asset management. Today, the stock is yielding a massive 6.78%. Aviva is known for offering financial products and services to both individual and corporate clients, helping them manage risk and secure their financial future. The company's diversified business model allows it to generate revenue from both insurance premiums and investment management, giving it a balanced and steady flow of income. For dividend investors, Aviva is an appealing stock due to its strong cash generation and commitment to returning capital to shareholders. As an insurance provider, Aviva benefits from a stable, recurring revenue stream in the form of premiums, making its financials relatively predictable. Additionally, the company's focus on capital efficiency and restructuring in recent years has improved its financial position, enabling it to maintain or grow its dividend payouts. This steady income, combined with a higher than average yield compared to others in the FTSE100, makes Aviva attractive to income-seeking investors. With a broad customer base and strong brand recognition, Aviva holds significant position in the financial services sector, providing essential services to millions of policyholders. Its size, stability, and commitment to shareholder returns makes it a popular choice for investors looking for long-term income opportunities. Aviva has a history of paying dividends for more than 20 years. While the company has cut its dividend 3 times in the past 18 years, it has since resumed its payouts, showing commitment to delivering value to shareholders. In doing so, the company has also experienced strong capital growth, up 33% in the past year. Number 3 on the list is Lloyds. Lloyds is one of the largest financial institutions in the UK, offering a wide range of banking and financial services, including personal and commercial banking, mortgages, loans, savings, insurance, and wealth management. Today, the stock yields 5%. While lower than others on the list, the stock has had a dividend cover of over 2 times for the past 5 years, making it well secured, especially compared to historic periods. While you'll know Lloyds Bank by the name, the group operates through a number of other household names as well, such as Halifax, Bank of Scotland, and Scottish Widows. With a focus on retail banking, Lloyds serves millions of consumers across the UK, providing critical financial services that underpin the country's economy. Lloyds is a popular investment for income due to its strong market position and profitability in the UK's banking sector. While the banking industry can be cyclical, Lloyds' dominant position in retail banking gives it access to a stable customer base, particularly in mortgages and personal loans. The bank's capital strength and ability to generate significant profits from these operations allow it to offer attractive dividend yields. Investors often look to Lloyds for income, as its dividend payments can be an important part of the bank's appeal, especially after its recovery from the financial crisis. Lloyds has a market capitalisation of around £35 billion, making it one of the largest banks on the FTSE 100. Despite some challenges in recent years, including unprecedented interest rate fluctuations and economic uncertainty, Lloyds continues to benefit from its vast customer base, efficient operations, and strong balance sheet. Its size and market dominance ensures that it remains an essential part of the UK economy. Lloyds has paid dividends for several decades, although the financial crisis led to several years of dividend suspensions as the bank underwent significant restructuring. Since resuming dividends in 2014, Lloyds has steadily increased or maintained its payouts, reflecting its improved financial health. While the pandemic led to another temporary suspension of dividends in 2020 at the request of regulators, Lloyds reinstated its dividend payments in 2021. This commitment to returning capital to shareholders even after economic disruptions has reinforced Lloyds' reputation as a reliable income stock for long-term investors. While it may not have the strong track record of the other stocks, these two unprecedented economic shocks have not deterred the company in continuing to pay out dividends to shareholders, and the rebasing of the dividend looks to be an attractive income yield at the current stock price. And with a dividend cover of over 2 times, the stock remains well positioned to grow the dividend in the future. At number 4, we have GSK. GSK is a leading British multinational pharmaceutical and healthcare company, known for developing medicines, vaccines, and consumer healthcare products. Today, the stock yields 3.51%, but with significant dividend cover for further growth. Its vaccines division is one of the largest in the world, providing vaccines for diseases like influenza, shingles, and hepatitis. It's also a global leader in consumer healthcare with well-known brands like Sensodyne, Voltaren, and Panadol. Its diversified portfolio makes it a key player in global healthcare. Like others on this list, GSK boasts stable and resilient cash flows, driven by its strong position in both pharmaceuticals and vaccines. As a healthcare company, GSK operates in a relatively defensive sector, meaning its revenue is less affected by economic downturns. This has enabled the company to maintain a steady dividend policy over the years. While the dividend may not have grown significantly, it has provided high yields and relatively low volatility. In terms of size, GSK is one of the largest pharmaceutical companies in the world, with a market cap of £67 billion. It's a major component of the FTSE 100 index and operates in over 100 countries, employing tens of thousands of people globally. Its size and global presence provide it with the resources to invest in research and development, helping to secure future revenue streams. GSK has a long history of paying dividends, with a record of over 20 years of consecutive payments. The company has typically maintained or grown its dividend, offering a reliable income stream for investors. However, in 2022, GSK underwent a major restructuring by spinning off its consumer healthcare division into a new company called Haleon, which resulted in some adjustments to its dividend policy. Despite this, GSK remained committed to delivering value to shareholders and its sustained dividend payments, even through periods of significant change. Finally, at number 5 is SSE. SSE is one of the UK's largest energy companies, primarily involved in the production, transmission, and distribution of electricity and gas. The stock yields just over 3%, which is partly down to the impressive share price growth it's experienced, currently up 73% in the last 5 years. SSE is a leader in renewable energy generation, particularly wind power, and it operates one of the largest renewable energy portfolios in the UK. The company also plays a crucial role in maintaining and developing the UK's energy infrastructure, including managing high-voltage electricity transmission networks in the north of Scotland. SSE's commitment to sustainability has seen it heavily invest in wind farms, hydroelectric power, and other green energy projects, aligning it with the global shift towards a low-carbon future. SSE is a popular choice due to its consistent and attractive dividend payouts. Like National Grid, SSE operates in a highly regulated and relatively stable industry, allowing it to generate predictable cash flows. Investors value the company's strong dividend, which has historically been higher and more reliable than many others in the FTSE 100. SSE's focus on renewable energy also makes it an appealing long-term investment for those seeking exposure to sustainable infrastructure while benefiting from regular income through dividends. SSE is a significant player in the UK's energy market, with a market cap of over £21 billion. The company is a key contributor to the UK's renewable energy targets, producing more electricity from renewable sources than most of its competitors. SSE's strategic investments in offshore wind farms and other green energy projects ensure its growth prospects as the world moves towards cleaner energy sources, giving investors confidence in its future profitability. SSE has an impressive track record of paying dividends for more than 30 consecutive years. The company has also sustained or grown its dividend for over 20 years, with the exception of a cut during the pandemic. This demonstrates the quality of the stock. Although SSE adjusted its dividend policy slightly in recent years to balance growth investments in renewables with shareholder returns, it remains a highly reliable income stock. Its long history of steady dividends, combined with its growth in renewable energy, makes SSE a solid choice for dividend-focused investors. So there you have it, 5 of the top dividend stocks on the FTSE 100 to invest in this year. If you got value out of this video, make sure to give it a like down below and subscribe to Wise Wealth for more personal finance and investing content. Thanks for watching, and until next time, see ya.